Hey guys, welcome back to the Capital Mindset Show. Today we're going to be going back to an older video and kind of revisiting some of the points I made, and it's regarding the liquidity crunch and some of these canaries in the coal mine, so to speak, that we did discuss in that video. We'll actually be revisiting here today. Now, the themes of that video, I will be trying to summarize it so you guys don't, of course, we're not going to watch the whole old video. Of course, you guys can go back and watch it. And actually, I found out today, I understand now why this video did not get, how do you say, it didn't get views. It didn't get a lot of views because I figured out I got a copyright strike on it. I didn't even realize I got a copyright strike on it. But it wasn't just any ordinary copyright strike. It was actually region restricted copyright strike. So unfortunately, those of you in some regions won't even be able to see this video, which is actually sucks, I know. So I thought that when I made that video, you know, I had a little funny meme using The Office in the beginning of it. It's actually available to see on the Instagram, and that's what the Instagram kind of helps me out from now on. It's going to do that. And so this was actually towards the part of the channel where I started to be a little bit more organized with my thoughts, because previously, in order to get these little tidbits where I would, you know, share my thoughts on kind of like the macro environment, I wouldn't have a dedicated video. I'd kind of just mention it here off the cuff, regarding, you know, like a particular stock. And the problem is that particular stock might not get a lot of views because perhaps it's not really that interesting to most people. And I thought that was fair because I thought, you know, oh, Capital Mindset's going to be a channel that we review all kinds of stocks, not just the popular stocks that everyone really cares about. Of course, I want to also talk about the stocks that I like to invest in, but, you know, primarily the audience really dictates the direction of the videos. Now, on to this video. Again, unfortunately, I found out, you know, you can't even see this video, some of you, because it is region locked. But if you can try to see this video, definitely, you know, if you want to. Otherwise, I'm going to be summarizing some of the themes here. All right, so that video I'll actually pull up right now, and we're going to hear my past self kind of talk. But here, the video, this is the title of the video. Will the market bottom soon? Stonks crashing. You know, I like to have fun with the title. Stonks crashing, deleveraging, strategy update. This is a concept video, part of the concept video series. It only got 138 views, and that was abysmal for back in those times. Even though this channel was much smaller back then, 138 was fairly low, and something like this, you know, probably wouldn't have gone. Also, I found out that YouTube was probably not recommending this video a lot. So regardless, the point kind of still stands, and I will share the tidbits of information I shared with the audience back then. And then, has anything really changed today? So there's going to be two pieces or two clips. Okay. And again, if you look, I'll just like skim through this because I'm not going to play it, but you can see like there's a meme here with The Office in the beginning. You can see that in the preview playback. And it's fairly funny, I say, especially with the context of the time of what was going on at that time, right? You had Meet Kevin selling off and all that. All right. So we'll just hear myself real quick and see what I had to say. So what are some stocks that we can actually witness or point to show the deleveraging event, the beginning of the deleveraging event? These are like what we call the canaries in the coal mine, okay, so to speak. Now, I will start to share a variety of different stocks. We'll go over those stocks ourselves here, but I went over a bunch of stocks essentially that were very popular among retail investors. And the premise of this video was to kind of highlight to everyone what I've been talking about for quite some time at this point on the channel, which I was calling the liquidity crunch, okay? You can call it whatever you want. There's probably going to be different names for what it was. And I showcased earlier in the video the amount of leverage in the system and why these canaries in the coal mine, that's the vocab term I kind of call the following stocks that we're going to subsequently look at, what the heck was going on, okay? And then a lot of people now perhaps are saying, well, you know, this was published in January 24th, 2022. So the dates matter. Dates really do matter. These are my thoughts and concerns then, and then we saw things play out. Well, a lot of those stocks performed terribly. In fact, came down quite a lot. Okay, so I'm going to share another clip with you guys from this video. All right, to save some time, I just jumped us over here. So this is the second tidbit that I want to share with you guys here. Okay, so I hope with what you guys can see here, these are the canaries in the coal mine, And in the videos, both in December 16, 2021, January 7, 2022, on this channel, we were discussing these aspects. We discussed them here and there in little tidbits back in November, little concerns that were. So those dates were specific dates of particular videos. At the time, again, there was less videos, so it's much easier to navigate to those videos, and those videos are still there. And you see, like here, I'm still going through that process, and here I'm realizing that, you know, my organization could have been better in terms of how to organize my thoughts, because if I share these thoughts in videos with titles and, you know, about stocks that no one's going to want to watch, then I don't really get that information out there. However, the internet is a wonderful place that documents everything. And so the videos are still documenting my thoughts, all right? Because they're still out there. It's just, you know, if people choose not to watch them, that's fine. But let me continue here. Jittering, but they weren't, you know, manifesting just yet. But then the big move started to happen in December for my portfolio. That's kind of a reiteration of some strategy. I would be paying attention to when the retail investor truly begins to panic, and that will be a sign when things are actually getting better. I wouldn't go out and panic sell. All right, so I'm going to just give the whole spiel of panic selling, blah, blah, blah. But no, that last part was actually, I still believe that. And regarding, you know, when something kind of eases out, you have to see when it is that retail actually starts to panic. And still to this day, I would say that a lot of investors, the retail investors, are still not that much panicky, even though some are capitulating to some degree. I see, you know, people are becoming more negative on certain stocks. And as you can see, I, you know, put my money where my mouth is. I've been buying some of those stocks, going against what I would say is the loud voices. I don't know if that's the majority, but the loud voices for sure in some companies. Now, just because your stock is going down, doesn't mean it is a buy. That's actually not a fallacy in and of itself within investing. And in fact, you have to be very careful, because these canaries in the coal mine, they usually are the first or are some of the best beneficiaries during a liquidity pump, but during a liquidity crunch, their true colors show. It's basically like the tide rolls out, and then you kind of get to see who's actually doesn't have their trunks on. And so a lot of these companies, I would say, are of subpar quality. And then in that instance, you get to actually kind of realize that, maybe to a greater extent than you might like, because, you know, your portfolio and you might be losing money, etc. But just keep that in mind. So I kind of outlaid a little bit, or I mentioned my strategy that I'll actually talk about. I started showing the portfolio just around after 1,000 subscribers. But just before, you know, I was making videos about me changing my portfolio strategy, preparing for this liquidity crunch, which wasn't really a surprise. All you really had to do was pay attention to what the Federal Reserve does, or the Federal Reserve was saying. And here's the thing, because even if you have been Snyder-pilled, so to speak, I'm kind of on the verge of it, that, you know, the Federal Reserve doesn't actually control the interest rates as much as people think they do. He still acknowledges that there is an aspect to the psychology of the Federal Reserve and what it does. So in that instance, that can still affect behavior. And considering where we were at the time, where we just had a liquidity pump in 2021, and there was a ton of leverage into the system, it was more probable than not that a liquidity crunch was on the horizon. So in essence, I prepared for that. And especially since we saw that there were some concerns with the banking sector. So I've been talking, and I mentioned it in the last video, and I mentioned in pretty much every single video where I did an update on the portfolio, where Citigroup is in the portfolio, but it's just the remnants of the other banks that I sold off that were part of the sales during my preparation for the liquidity crunch. I had Bank of America, JP Morgan Chase, Wells Fargo, Morgan Stanley. I had all those stocks in my portfolio up until the end of 2021, okay? And those were part of the ones that just went out, all right? And Citigroup was the only one that stayed as a speculation, and it's a very small part of the portfolio. I'm not heavily exposed. I'm more exposed to insurers. Insurers are was my belief, would benefit more from rising rates than banks, because banks don't make money necessarily on rising rates. That's a fallacy that I've talked about on live streams, which, by the way, you guys should totally join, because I do like to talk about a lot of things. I answer questions live, but it's a fallacy, okay? They make money on the spread, okay? On the spread. It's very important. A lot of people get that wrong. A lot of people in financial media, a lot of people here on YouTube get that wrong. And I've shared that little tidbit in the video dedicated to banks, which still deserves a really big video. That will be over an hour long when I get to that one. But I gave you guys like kind of an appetizer video for that. There is that one's already on the channel. It goes a little bit into some details about banks. All right, so let's actually review some of these stocks, so to speak. So some of the stocks that we're going to be going over are pretty much the YouTube stocks. And towards the end of the video, I will promise you again that there is something I want to share with you guys, or I want to announce to everyone that will be implemented this week. Okay, but we'll see it. All right, so first things first, I had Google because, you know, I love looking at Google every day. No, I'm just kidding. I was just comparing Amazon and Google. So we're going to look at some of these stocks. And so again, let's remember when I made this video, January 24th, 2022. So year to date, January 4th, 2022. April, January. Yeah, around here. And this was already following, again, before when we were already stating a lot of ultra negative things, because there were videos about this company around here. And then this was another video. This was not a video specific to that. It was kind of referring to the beginning of the liquidity crunch, because these were what I called canaries in the coal mine. They were letting us know that it was happening. And always, if you read financial history, always this is the case, by the way. It's like history repeats itself, and people are always in denial about it when in the moment. And so I actually was able to witness it firsthand, the denial of it, because a lot of people were saying, even when I made videos about this, that these were fantastic companies, that they were growing very fast, and revenue growth is amazing and stuff. Anyways, regardless, here we are. And then from this video, you know, they're down 35% at the time of making that video. Let's also look at this one. Look at that. It's up today. All right. So January. Where are you at? January 24? 24. All right, down 33.55%, and this is already after its drawdown. It was down more, right? But we were kind of explaining that because last year again was the liquidity pump, and then from there it's just downhill. Also, another one that we did cover a little bit. I won't actually get into one of them because there's a dedicated video that should be out already for it. Voyager Digital. And this one's a long time coming. I'm very excited to do this video. I'm not going to lie. Yeah, you get the picture. I won't bore you guys, but down 56%. So the point is, you know, we still were going through it, and these are all canaries in the coal mine. Even, you know, you take a look at Google, right? Google, remember there's canaries. Canaries are early indicators. And then so something like this would be a lagging indicator, because these are more flights to safety. They're considered flights to safety. So typically, in an academic sense, you would see that happen after. So for a while, you know, it really gone nowhere, and actually went up during the same time period when these things went down. And then now you see, but these won't react to the same degree because these are quality businesses, right? Even if something like Facebook, right? If you actually take a look at Facebook happened a little bit faster, and you know, you might say that this was driven by earnings, right? When you're absolutely right, okay, this drop right here. But the thing is, when you're in that moment, it's like a balloon that's filled up. It just needs a little prick, and then, you know, the movement's very fast, dramatic, right? Netflix, same thing. You know, Netflix, the move is very dramatic. Okay, that's typically what we tend to see. And so, oh dang it, it's up today. Well, I mean, I still want to add to my Facebook, but I'm sorry, not Facebook, Netflix, but because I still want to actually bring it up a little bit in terms of percentage allocation. So even in the year to date, let's look at the year to date. So year to date, where's the 24th? All right, 24th, there we go. So since the 24th, it is down 48.48%. Netflix was considered to be the more volatile, more speculative, more definitely the more volatile of the FANG stocks. And you can see it was one of the first ones to kind of have this downturn. And by the 24th, when I made this video, it was kind of showcasing, again, this at this point, a lot of the canaries kind of showed themselves. And so from there, you can actually derive that these are probably early warning indicators. Of course, now here's where I'll take a pause here and state, no one will know exactly when it ends. You don't really know, and I won't pretend to know. And I stated that in the previous video as well. I stated that it appears like the signals are or tend to be that, retail is capitulated. There's a lot more pessimism in the market, but that doesn't mean that the trash companies will go up again. That actually doesn't mean that, and I think that's a fallacy that people are going to fall into. So some of these companies will severely underperform the market because they are severely overvalued based on their fundamentals, right? And yes, revenue is not the fundamentals. Revenue is just a fraction, a piece of it. Price to sales ratio, don't get me started. But with regarding, the end of things, right? And I might title this video, I guess, something along those lines. But you just don't know. So what I'd say is, for the most people, it's just better off just to continually add to the positions that you truly believe in for the long term. And be careful with that. I state that's an easier said than done thing to do, because you could just be wrong. But if you're an index fund investor, you just keep adding regardless. None of this really matters. This is kind of more for those of you who are only sticking to individual stocks, and you can see that or appreciate the amount of work that you might have to put into it, and you still might not outperform. Okay, you have to consider that. You still might not outperform the market, but it does take some work. You have to take these things a little bit seriously, and there will be times where your psychology is tested. Now, a lot of people might take this as a false indicator to say, you should always be buying the dip. Well, that's not necessarily true, because again, the individual stocks that you might be picking might be very bad companies. All right, I'm not going to point out anyone in particular here, but I think you guys can get the idea of who might fall under this category. And the companies that they're picking have very structural problems. So big structural problems, and their thesis is, fairly simple, that doesn't take into account a bunch of factors that may actually hinder the performance of the stock over the longer period of time. And it's very easy to punt the ball and say, well, my returns will come in the future. My returns will come in the future. We can always say that, okay? But, regardless, when we look at a lot of these stocks, what I personally believe is that they have done well during a liquidity pump, when there's a lot of money flowing through the system, when leverage was going up and up and up in the system. A lot of retail was coming in, a lot of retail who perhaps doesn't know much about the fundamental value of a company. And, this is actually from conversation. I know anecdotal evidence, but when I talk to a lot of people, sometimes they kind of emphasize more than not the importance of sales growth. Sales growth is very important. And it's like, while that is important, it is not the prime factor in terms of determining a successful company. In fact, the analogy that I've kept saying, and I've said this for quite some time on many, many videos, is we can start a $100 million company with $200 million, because then we can find everyone and we can say, I will pay you $2 if you give me $1. And there you go. You have a $100 million company. So that metaphor, I love it because it implies a lot of things. It implies the question of scalability, the question of sustainability, all these things that come into question without actually considering the longevity or in terms of share dilution or all of that stuff. All right. So this video is, I'm gonna end it here. It's supposed to be a simple video. Hopefully you guys enjoyed it. If you guys did, feel free to leave a like. If you're not subscribed, go ahead and subscribe, and you can come back to the channel and find something. Maybe I'm talking about a stock that you're particularly interested. Otherwise, I'll see you guys in the next one. Bye. Oh, and completely almost forgot about the last thing that I was going to mention. So this will just be at the end of the video. So if you didn't leave yet, congratulations. You get actually to find out what it is. So essentially what I've been hinting at is creating what is called the YouTube index. And so after some feedback from various individuals, I have decided to do an equal weighting, because if I had done a market cap weighting, it would have been 97% one company pretty much. So I decided to do an equal weighting of each of the stocks, and yeah, so I will actually be putting some money into it. It will be a small part of the portfolio. It'll be for fun. We'll keep track of it. We'll see if it outperforms, and I'm going to actually treat it like its own separate portfolio. So I'm not actually going to put it in the regular section with the portfolio. I'm actually going to put it in a different sheet, and it will just be a one and done buy, and I'll buy it pretty soon. I'll buy it throughout sometime this week, and I'll buy all the shares listed in that, and you guys will probably see that updated in the portfolio that's free for everyone to see. If you guys want to know where the link is, it's in the last portfolio update video that was published on the 2nd, so 5/2/2022. And there in the description, you'll see a link for that. And it's just a link that takes you right to it. So in one of the sheets, you'll see it'll be called the YouTube portfolio, and it's going to be tracking all of the popular YouTube stocks. All right, guys, on that note, this is the actual end of the video, and I'll see you guys in the next one. Bye.